The year 2023 has been described as a mass extinction event for startups, with U.S. company bankruptcy filings reaching their highest level since 2010. According to Aaron Griffith of the New York Times, a staggering $27.2 billion in venture capital money was put into 3,200 venture-backed firms that failed within the first 11 months of 2023. However, this statistic may merely scrape the surface, as many firms went out of business without making any major announcements. Notably, the $27.2 billion figure includes big startup failures such as WeWork, which went public, or others that were bought at far lower prices. According to PitchBook, nearly 3,000 private venture-backed firms have suspended operations in the last year alone. A considerable proportion of firms soliciting finance obtain lower values than in earlier investment rounds. Also, venture capitalist engagement in the startup ecosystem decreased significantly, with 38% of VCs withdrawing from deal-making. This tendency coincides with a large number of layoffs in the IT industry. The distress isn't confined to the United States alone. S&P Global reports a surge in corporate bankruptcy filings, hitting levels not seen since the aftermath of the 2008 global financial crisis. In England and Wales, corporate insolvencies soared to their highest levels in over a decade as businesses grappled with soaring borrowing costs and tepid demand. In this video, we embark on a journey to unravel the reasons why startups are shutting down, drawing insights from real-life case studies to decipher the intricate dynamics at play in the startup ecosystem. One of the primary reasons for startup failures is the lack of market demand. Despite promising ideas and innovative solutions, startups often struggle to resonate with their target audience. This lack of market demand can be like chasing after a mythical unicorn. You pour your energy into something that ultimately doesn't exist. Picture this: someone constructs a beautiful bridge only to find that it goes nowhere. That is what happens when a good or service isn't in line with what the market requires. It is possible for this mismatched product-market fit to result from a failure to comprehend or an incorrect interpretation of your client's preferences. If a startup's product or service doesn't match the real demands of the market, it might fail. This may result from a misreading of consumer preferences or insufficient market research. Many were dazzled by Hyperloop One's bold desire to change transportation through a high-speed tube system. Be that as it may, despite huge speculation, the thought didn't get on, and there wasn't sufficient interest in it, which ultimately resulted in business closure. Utilizing a Hyperloop innovation to re-examine transportation was not generally welcomed by shoppers. Bird, the electric scooters rent startup, saw a similar outcome. Even though the company extended rapidly in the beginning, in the end, it sought financial protection due to issues saving up a consistent interest for its administration. It was additionally featured by the way that bikes were now and again left in streams, which proposes that the degree of care offered and the requirements of the clients are not adjusted. A niche market is a more specific region of the bigger market that serves a specific client base with specific requests or inclinations. Various elements, for example, lacking business sector interest, trouble separating the firm from adversaries, and challenges growing the business beyond the particular area, can make new companies bomb in specialty markets. Also, on the off chance that the target market is minuscule, organizations might experience difficulty making money in that niche. While offering a helpful and complete wholesome arrangement, Soylent took care of a moderately small niche of health-conscious people looking for fee substitutions. This restricted market size made it hard to accomplish critical development, particularly with contenders offering comparable items. While the web-based bedding market was developing, Casper confronted rivalry from laid-out brands like Tempur-Pedic and Serta. Furthermore, the sleeping cushion market itself is moderately small and rare concerning individual buys, restricting Casper's development potential.
The Casper Original Pillow is a people pleaser. Its fluffy synthetic down fill and medium firm support make it a great pick for back sleepers, side sleepers, stomach sleepers, starfish, you name it.
For startups attempting to break into the market, established firms with a greater market share, financial resources, and name recognition can provide serious obstacles. Regulatory obstacles made their expansion much more difficult. Quibi was made for broadcasting short videos to draw in portable clients. In any case, it needed to battle with extreme rivalry from notable platforms such as Netflix, TikTok, and YouTube, all of which had a greater variety of content offered and greater client bases. Their breakdown was a consequence of exorbitant production costs and an absence of uniqueness. While the housing market is enormous, Opendoor, the web-based trading space, was at that point swarmed with laid-out players like Zillow and Redfin. Opendoor attempted to separate itself, but confronted numerous difficulties with productivity, prompting cutbacks and a likely deal to bail out. Regardless of being a key player, Grubhub confronted furious contests from Uber Eats, DoorDash, and Postmates. This competition prompted price wars and trouble procuring new clients, finishing in a consolidation with Just Eat Takeaway. Startups often fail due to poor execution, even with a promising idea. Flaws in execution can affect marketing, product development, and overall management. Ineffective marketing and insufficient sales strategies or weak marketing plans can hinder attracting new customers and generating revenue. Take Gobble, a meal kit delivery service, for example. It struggled to differentiate itself from established competitors like HelloFresh and Blue Apron. Their marketing failed to effectively target a specific audience and communicate their unique value proposition, leading to difficulties in acquiring new customers. Similarly, Vero aimed to provide a more ad-free and private social media experience, but their limited marketing efforts failed to attract a substantial user base to compete with platforms like Instagram and Facebook. Delays, quality issues, or a failure to adapt based on feedback can result in a subpar product that struggles to gain market traction. Consider Juul Labs, an e-cigarette company that faced numerous product development challenges related to addiction and health concerns. Additionally, they encountered regulatory changes in 2023, including stricter marketing regulations and flavor bans, further impacting their market share and leading to product withdrawals. Similarly, Spoon Rocket experienced quality issues and delays in its meal delivery service, resulting in negative customer feedback regarding inconsistent quality and long wait times.
From the first day that we started WeWork, it was about bringing people together. There's an energy that you feel. That energy is something that's hard to explain. It's something that either you feel it or you don't. We like to call it the we generation.
Internal conflicts, leadership issues, or a lack of a cohesive vision can impede decision-making and overall company performance. WeWork, for instance, grappled with internal disputes between the founder and management group, resulting in questionable business decisions and unsustainable growth. Their failure to articulate a clear vision and leadership problems ultimately led to their downfall. Similarly, FTX's CEO faced accusations of fraud and mismanagement, resulting in significant financial losses and insolvency.
Turning now to the latest on disgraced crypto founder Sam Bankman-Fried. Now apparently willing to waive extradition back to the U.S. to face fraud charges for the collapse of FTX.
Lack of transparency and leadership failures eroded trust and led to a complete collapse. Financial mismanagement is a common pitfall for startups, often resulting in the depletion of resources and eventual failure. Cash burn rate startups often struggle with managing their finances, leading to rapid depletion of funds before achieving profitability. Although achieving success, DoorDash struggled with profitability due to high customer acquisition costs and operational expenses. They consistently burned through cash, requiring multiple funding rounds, despite significant revenue generation. Despite rapid initial growth, Bird faced high operating costs, particularly with scooter vandalism and maintenance. Their rapid cash burn rate outpaced their revenue growth, ultimately leading to bankruptcy. Some startups may focus too heavily on raising capital rather than building a sustainable business model, leading to dependency on external funding rounds. Connected H, a health tech startup, secured millions in funding but failed to achieve significant market traction. Their reliance on investor capital without a clear path to profitability ultimately led to their shutdown. Inadequate financial planning and excessive expenditure on non-essential costs can exhaust resources without producing equivalent benefits. WeWork was accused of overspending on unneeded amenities and botched acquisitions. Their failure was influenced by their improper resource allocation, which resulted in unsustainable financial practices. Smile Direct Club raised money for marketing and promotion despite reservations regarding the caliber of its goods and the contentment of its clients.
Smile Direct Club guarantees your smile for life. Your life.
Their collapse was eventually caused by this misallocation of resources, which took money away from important areas like enhancing their product and customer service. Regulation changes may have a big effect on companies, changing how they operate and how far they can go. In 2023, there were calls for tougher regulation and taxation of the cryptocurrency sector, which led to heightened governmental monitoring. Although Coinbase adjusted to some degree, investor trust in the cryptocurrency market as a whole was affected by the shifting regulatory environment. Brexit-related rules and practical difficulties in the aftermath of Brexit Britain limited Oya's capacity to import and distribute specific goods that hampered their business operations and prospects for expansion in the UK market. The attitude of investors is a major factor in determining how successful businesses are. Investor perception of startups saw a dramatic shift in 2023, highlighted by a departure from the decade-long growth at all costs mindset and an increased emphasis on profitability and long-term business plans. The significant losses that SoftBank has incurred on its startup investments, including WeWork, highlight the significance of investor opinion. Startups have increasing difficulties in obtaining finance as investors grow more hesitant to support untested business strategies. Perhaps the most critical factor contributing to startup failures is the sustainability of their business models. Real-life examples illustrate the consequences of unsustainable growth strategies. WeWork's gigantic business model prioritized rapid expansion over profitability, ultimately leading to its downfall. The company's failure to achieve sustainable growth highlights the importance of a sound business model. Bird's business model of renting scooters faced challenges in achieving profitability, emphasizing the need for sustainable revenue streams and long-term viability.
Well, you may have seen their electric scooters around Metro Atlanta. Now Bird, the company that owns them, has filed for bankruptcy protection.
To sum it up, there are many reasons why startups shut down. These range from market changes and problems with how the business is run to money issues, competition, dealing with regulations, changes in how investors feel, and having a business model that can't last. By looking at examples from real startups and getting a grip on the difficulties they face, entrepreneurs can handle the ups and downs of the startup world better and improve their odds of making it. If you found this video helpful, remember to give it a thumbs up, subscribe to our channel, and share it with your friends who want to understand why startups are struggling in 2024.